Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name's Randy Smith, and I will be your host today. And really excited. We just keep getting better and better guests on our show here. So we have Andrew McNair with us today. Andrew is the president of SWAN Capital. He manages well over $400 million in assets under management. He's got 10 years experience in real estate investing in multifamily, RV parks, storage, short-term rental, and industrial. He's got a weekly radio show called What Your Money Would Say. He's the podcast host of A Rich, Young, and Powerful. And finally, he is not just the author of one, but 3 books that I'm sure we'll get into some of those details in this show. But Andrew, welcome to the show. So excited to have you here.
Well, I'm glad to be here. I mean, that was really a great lead up. I hope I can live up to it.
We all do, Andrew. We all do. Well, let's jump in like we always do. Can you give us your assessment of today's market and how you think that might be impacting the passive investing community and passive investments as a whole?
Yeah, I mean, I'll probably come in with an interesting perspective. Since I am a financial planner, we have a total wealth management company where we have a CPA and estate planning attorney all under one roof. So I'm meeting with 6 or 7 retirees every day. And so we're talking not about just real estate, we're talking about public market, private markets. And so we're looking at this from a holistic economy perspective. And so in just a few weeks, I'll do my state of the market where I'll spend 45 minutes talking about the economy. And one thing that's keeping us up, as well as my portfolio manager up, and where we're starting to get really cautious, is we track 2 of maybe 5 different thermometers of the economy, and that is the Shiller PE ratio and the Buffett indicator. And so if you look at the Shiller PE ratio, right now it is at 37.5 or 38 times earnings. So if you're not familiar with the Shiller PE ratio, that takes the price earnings ratio of the S&P 500, adjust it for inflation. And what we know is anytime it gets above 30, bad things have happened in history. You got the Great Depression at 30, you got the dot-com crash at 42, you got COVID that even hit 30, you got COVID at 37. So between those, we're now above that. So I always like to frame it for a client like if you had a lemonade stand that made $1 million a year and someone comes across your lemonade stand and offers you 38 times earnings, you're selling. Like you're taking off your apron and you're walking out the door. Well, when markets get that overpriced, it doesn't take much for one block to be pulled out for that Jenga set to start falling.
Okay, so that is the Shiller one. What about the Buffett metric that you guys are watching? What is that telling us now?
Yeah, the Buffett indicator tracks our GDP as a country compared to our stock market value. So right now it's at 208%. So we're 208% head over our skis. And that means that unless Mr. Trump gets our economy growing in a big way, eventually you can start tumbling down the mountain really quick. Anytime we've got above 2 standard deviations in history, it was only a matter of weeks or months before we had a major crisis or pullback. Now, again, that's why you should take this with a grain of salt. Yes, I've just given you 2 out of 5 metrics that are red hot. Thermostat is turning on soon. Or you could say, hey, it doesn't mean I need to go get in my bunker and, go downstairs and prep with tinfoil hat over my head. But what it does mean is that we need to start getting prepared. We need to start diversifying into other asset classes other than just public markets.
Okay, perfect. So, I listen to a podcast daily called Thoughtful Money, and I'm hearing a very similar sentiment from folks on that podcast as well. As you mentioned, it doesn't necessarily mean you need to pull all your chips off the table, but I'm curious, what are you sharing with your clients? What kind of direction are you giving them? How are you suggesting people proceed in this environment? Because one could argue 2 years ago, both of those metrics were way out over their skis, even 2 years ago. So at what point is it too early to pull out, or like what type of guidance do you give them?
Yeah, I mean, you got to take that data in one hand, but you also have to understand that the future is always different than the past, because we could go into a golden era like the 1990s where maybe deregulation does happen, government spending is reduced. All of those things would be so pro economic gains and growth that it would be like a 1990s period if it could happen, and I would love to see it happen as an American. But in case it doesn't, you have to be prepared for that. So many of my clients are retired, meaning they're 5 years from retirement or 5 years into retirement. So we have already navigated some of their assets into fixed investments. And then we also have to make sure that we have integrated some real estate into that. And so when we look at our Signet fund, CYGNET, Baby Swan, we're investing in different real estate asset classes that act accordingly based on economic flows. So if we see a really good expansion, our like short-term rental portfolio will do better. If we see a time of really bad corrections and people start getting evicted and they're moving or downsizing, well, of course, storage is going to do better during a period like that. So I think by making sure you have, again, I'm only speaking to retirees. So if you're still in sales, you're still 5, 10, 20 years out from retirement, you need to have a heavy mix of public, private, as well as real estate. But when you get to retirement, it's closer to a third in fixed assets, a third in public markets, and maybe 20 to 30% in private equities, aka real estate.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
So concrete, actionable steps that our listeners can take, certainly consulting with their advisors like yourself, but the general sense on what you're sharing with your audience. So let's, if we can, just to give the audience a little bit kind of broader view of who Andrew is. We've got your high level, who you are today, but you didn't start out managing 400 million in assets. Like, what is your journey in, 2 minutes or less?
Yeah, I can do that probably in 2 minutes. I can probably do that. So my story is like probably many of you. I read a book called Rich Dad Poor Dad. My parents handed me that purple book and said, "Hey, don't do what we did. We refinanced the house 3 times. Don't do it this way." And I took that to heart. And so I started interning at a financial firm because I started peppering my parents with financial questions, and they were sincere enough to say, "Hey, you need to find a Mr. Miyagi." And that Mr. Miyagi said, "Hey, I can teach you everything about money, but you're going to have to show up here, work for free, and I'll teach you about money." So from 14 to 18, you would see me interning at that financial firm, but I saved up by waiting tables at Denny's by the time I was 14 to 16, $62,000. And then 2008 happened. That'll date me. When I was 2008, I was 16. I stuck all my hard-earned life savings in the stock market. And to my surprise, right, it turned into $142,000. So I think that I might be Warren Buffett reincarnated. Like I have the golden
Sure.
touch, right?
Yeah.
Because everyone, you remember when you're 18, you had fashion figured out, music, you knew the best. And at least I thought I did. And so the best thing that could ever happen to me is I lost every single penny. The University of Hard Knocks called in the tuition payment and I lost everything. I mean, it's impressive to lose like half your money, but to lose 100%, you have to be a real dummy. And so I
just
did.
To correct, did you say the best thing that happened or the worst thing that could happen?
That's I said it correctly. The best thing that ever happened to me.
I would agree. Okay, good. Yeah.
What happened was I learned 2 very priceless lessons for me. For me, I had to learn these, and I'm glad I learned it early. Number 1 is you have to be diversified. I was about to buy a duplex in cash at 18, and I was meeting with a realtor, knew I was going to buy this property, and I said, I'm going to take one more cigar butt smoke off this one stock like Benjamin Graham taught me in the book Security Analysis. And then I learned what's probably the most important to me is I got really confused. The greedy voice that came over my shoulder that egged me on, I really started to confuse my self-worth with my net worth. And I made a promise to myself. I said, one, I'll never not be diversified again. And number two, I won't just think that the happiness that in my life is going to come from the accumulation of things in net worth statements. It's going to have to be something deeper.
Awesome. Awesome. So you had that awareness and you decided to go. Did you buy the duplex or did you go on and do something else?
No, I lost it all right before buying it. So
you did? Okay.
it's actually right next to my church that I still attend. So every Sunday, it's a good, humble reminder of what greed can do to you.
I love it. I love it. Very good. So you made a very specific shift at that point and you decided to go down the path that you're on today. So was that just a matter of, did you go work for some other brokerage firm or like, what did you do? Like, how did you get to where you are today?
Yeah. So as I was picking up the pieces of my life, I mean, the best thing that ever happened to me was after putting my pieces together, my mother asked me if I would want to move in with my grandfather because sadly his wife of like 60 years had passed away. And so here was my grandfather, 3-war veteran, never been a bachelor since he was 25, been married this entire time. He's 93 now. And I thought I was doing him a favor by moving in with him. Like, hey, I'm going to take care of my grandfather. But it was actually the complete opposite. He really took care of me in that period of time because he poured into me. We would walk miles. At 93, still walking miles. We'd walk miles together walking. And he just told me about what it was like to live in the Great Depression, but how generous the people were still during the Great Depression. And I thought, that's crazy. Like, you mean that during the Great Depression, they were giving more percentage of their income than we do today? And I fact checked it and it's true. Like, we're less generous than we were during the Great Depression. And to me, that's tragic.
Now, and I believe you actually wrote a book about tithing. Can you share how maybe some of those lessons that you learned from your grandfather about what was going on in the Depression, how that might have influenced some of the work that went into that book? Or
Absolutely. So the giving crisis is all about the crisis that we have in the United States, that we're not much of a generous people. And I think that's why depression and anxiety is going up and up and up, yet we've never been more wealthier than any other civilization in history. And so my grandfather poured into me, and I felt that story needed to be shared. But what happened was I picked up the pieces and I started wanting to build my own firm. So I thought, you know what, I want people to not worry about money like I had been worrying about money. And so I came up with the firm Sleep Well at Night Capital, SWAN Capital. And so it started out of my trunk. And so I always am very thankful for our original clients that handed me $500,000, $250,000 when I was in my trunk of my Camry. And that's how I started SWAN Capital. And then the rest is history. You know, you build a team of 19 great individuals and they make it look really easy for me because they do all the really heavy lifting of building beautiful plans for clients. And so those were the harder days, and that's how it all began. Now it's I wouldn't say it's easy street, but it's a lot easier.
Fantastic. Yeah, very neat story. And thank you for going into that as well. I think you can tell a lot about somebody, where they came from, and some of the stories that drove who they are today. So thank you for jumping into that. So, you know, we're sitting at an interesting time where this is actually being recorded in middle of January. It'll be published probably in February. Some big things going on in the market, in the economy, in politics right now that are affecting everybody's pocketbooks. I'm curious what your thoughts are as we go into this new year, this new administration, on the market. Like, where should people be focusing and what should they be keeping their eyes on as maybe indications of changes that are potentially on the horizon?
Yeah, I think anytime we're at all-time highs or all-time lows, it's one of the best times to say, hey, when's the last time I rebalanced? When's the last time I rebalanced my 401k? Am I in the right risk tolerance? Because when the roller coaster ride takes a turn for the worst, you want to be ready for that corkscrew before it happens. You want to start bracing yourself for that and make sure that you're driving the speed that you're comfortable with. Because it's okay to drive in the school zone if you know you're there, but to find you're actually on the on-ramp to the Autobahn, two different stories. And then I would also say, not only after rebalancing your 401k, checking your IRA, make sure it's rebalanced, I would make sure sure that you've allocated properly to real estate. Real estate is a great asset class because during a high inflationary period that we will still have symptoms of this inflation go on for years, you want an asset class that's going to keep pace with inflation. And I've realized a lot of clients, they still have money sitting on the sidelines. And of course, it'd be great to time it perfectly, and late 2025 or early 2026, there's this recession that I'm not aware of, this market correction that I'm not aware of. But let's say you timed it perfectly. Well, you could still miss out in the time frame of waiting. You know, all the families that have been waiting and waiting, well, by the time you have got left behind, you could have actually already earned the interest, lost the money, and you'd still be back higher than where you are today. And so you don't want to try to time the market. That has always been a fool's game, and it always will remain so.
I love it. Yeah, no, I love it. So, yeah, part of my the way we talk with our investors and the people that we're working with is we believe that everybody should have at least a portion of their investable capital in real estate, commercial real estate specifically. And, you know, you had mentioned that if you're 10, 15, 20 years left in your career, maybe that percentage looks a little bit different. But if we can, let's focus on the person that maybe is just starting to allocate a portion of their investable capital. So maybe they've got $100,000 or maybe $150,000 or $200,000. How would you suggest that they go about deploying that capital into commercial real estate? Maybe asset class strategies, maybe vintages, maybe like, tell us what you do if an investor had a couple $100,000 to invest. Yeah.
Yeah, that's a great question. I mean, if someone has $150,000 to $200,000, I'm a big fan of percentage in passive and active real estate. So as someone that had 54 houses that they used to own with 136 apartments, you're always going to probably have the best rate of return if you managed your own real estate and you're willing to lose the hair like I have. If you can't see me, I've lost some hair, but you're going to go through some. Yeah, is that what happens to all of us? Yeah, maybe that's what happens.
Past active investor as well. Yes.
But I do think that the higher rate of returns are going to be found in active real estate, but it also gives you an appreciation for how difficult the game of real estate is. It requires blood, sweat, and tears. It requires building business plans and then breaking those plans and adjusting those plans when things don't always go your way. So I'm a big fan of maybe if you had 150,000, 100,000 would go towards passive real estate where you're giving up some of the gains, but you're leaving more meat on the bone for other investors and fund managers to help you with the diversification component, like what you do, like what we do, to allow families to have that diversification piece that without scale, they couldn't do it. Unless you have a $20, $50 million net worth, you could not achieve the diversification that we do within Signet. And so I would say 100,000 to something like that. And this is saying that this individual's already funded their 401k and Roth IRA, because again, I do believe in that too. But that other 50,000, I would put down on a duplex, a triplex, some sort of rental property, so that you can have your hands in active real estate as well. Because what I found to be true is if all of your money is passive, people get stir crazy and then they make terrible investments on the whim.
Interesting. Yeah, no, I would agree. Well, let's, if we can, maybe fast forward and look at somebody that has 20, 25, 30% of their investable capital, if that's in there. Do you have ideas or like, what are your suggestions about diversification? Do you have like exposure limits to operators or asset classes? Like, what are your thoughts there?
Yeah, absolutely. I think you have to do that. I mean, we do that at the nth degree. I mean, we make sure that we don't have too much in one state, because states can change their policies towards tenants versus owners. We want to make sure we're not too much in one city. I won't name any cities, but a lot of cities have gained and garnered a lot of the business, of course, because they've had massive population growths. But that doesn't mean that I want to have all my money in one city, let alone one state. I also want to make sure that I have operator diversification. We make sure that we never have more than 20 to 25% with one operator, because you start to get very heavy into that operator. And if they run into some financial troubles, yes, they have individual deals, but who's going to run those deals if they're in financial strains and they went through a divorce and they're going through some issues? That affects all of the properties that they manage. Then next thing we're looking at after geographic operator diversification, we're looking also at real estate type diversification. At multifamily multifamily/apartment complexes, as well as storage, short-term rentals, flex industrial, they're all going to operate different in economic cycles. And so it's very important. I think Tony Robbins should get the credit. It's important to understand first and foremost where in the cycle we are. That's the first step of investment maturity. The second is taking advantage of that cycle. Third is eventually impacting that cycle. And then there's eventually entrepreneurs that change the cycle. And again, you may never get that over your lifetime. I may never do that, but those are the cycles of investment maturity. Is first you have to understand where you are in each cycle. And so I think it's important to understand where we're at economically, because it will impact each type of real estate class.
Love it. Well, the obvious next question is, where are we in the cycle? And what's the best asset class for where we're at the cycle?
Yeah, I think everyone's eyes on interest rates. So everyone's probably reluctant to give their 2 cents
Sure.
because everyone that's bet against the Fed has really been disappointed. The Fed is artificially changing interest rates. And I also think there is this history bias that a lot of investors want interest rates to go back to where they were, and they want them to go where they never should have been. I mean, there's a reason why textbooks didn't talk about negative interest rates, is because they weren't supposed to happen. And so you're asking for something that shouldn't happen. So everyone's really adamant about the Fed lowering and lowering. And again, I honestly think that they're healthy where they're at, and they should have probably left them a little higher for longer, in my humble opinion. So I think you have to be very careful with where you feel like interest rate policies are going, and you should be asking the operators and the investment firms that you're working with what their outlook is on interest rates.
Love it. Yeah. And so with interest rates where they are and likely going to stay, who knows, maybe they go up, maybe they go down just a little bit throughout this year. Does that lend favorable to any one specific asset class, or what has you excited today in the real estate space?
Yeah, I mean, obviously it matters. I mean, there's a fundamental high correlation between interest rates and public markets as well as real estate, of course. So I mean, you need to stay tuned. I mean, obviously, with low paying interest rates, people are going to continue piling on into public markets because they're not getting the rate of return they want. But again, that makes the party go that much longer. And we already talked about that the public market is overvalued. So unless they get their feet underneath them and we can justify these prices with the earnings, then eventually we're going to have a really bad hangover if interest rates continually stay low or drop lower, and then people are piling on into the public markets, which would, I don't think long term be healthy without a pullback of some sort.
Yeah, and it seems really apparent that the Magnificent Seven is what's holding the whole thing up. And if you look at everything below the Magnificent Seven, they're actually showing year-over-year decreases. So it's pretty scary to think if those were to realign, what that could do to the stock market. And I guess what I'm concerned about, because I am heavy on the real estate side, is what kind of impacts does that have on real estate? Because a crashing stock market is going to impact multifamily, it can in fact impact real estate. And I don't think anybody really knows what truly is going to happen if that does what a lot of people are thinking. So
no, unless they have a DeLorean, no one really knows.
Yeah, no doubt.
And that's why asset allocation matters so much, because even the best traders, the best hedge fund managers, they get it wrong because no one does know the future. But what we do know and how we get it right is proper asset allocation based on your chapter of life. And this is where I think the biggest misconception is people think that it's age. And my job is to try to dispel that. The older you get doesn't mean the less risk you should take. It's based on chapter of life. Now they're correlated. The chapter of life that you get closer to spending your money typically is when you are older. But just because you're older doesn't mean necessarily that you take less risk.
I like that. Yeah, I left corporate America when I was 49 after 25 years. And I guess technically that was my retirement, but that didn't mean that I've moved on to a different chapter necessarily. So that's very
Sure.
interesting. Okay, yeah, very good. I'm curious. This is a different direction than I normally go with folks, but talking to somebody of your stature, I'm curious if you've read the book Die with Zero, and if you have, do you have any thoughts on that?
See, the problem is I've read a lot of books, and I'm
Uh-huh.
trying. I did read that book. Can I
Okay.
tell you exactly what the synopsis of that book is? No, I do. I like the title, but
Yeah.
it's open to interpretation. So I can't remember what that book's thesis was. So I'm scared.
Yeah. So the general premise was, everybody saves for retirement. They save to have this huge nest egg to give over to their kids, to charity, whatever that is. And the premise on it is that if your goal is to give your children or give charity dollars at the end of life, then why not give it to them today? Because you're going to get a return on experience. And odds are that that group that needs your dollars when you die probably needs them today. Your kids likely have home purchases, car purchases, education, those types of things. So why do we
Yeah,
save
I
this
can talk
huge
to
nest
that.
egg? Yeah, go
Yeah, I
ahead.
mean, I've definitely strong feelings about that.
Yeah,
I'm a big fan of doing your giving while you're living, so you know where your giving is going. I think
excellent.
John Maxwell said that, and I think there's so much truth to that, and especially because I think it helps us with our pride and our egos and puts it in check. So a lot of people say I'm self-made. I could do it all over again if I had to. People say things like that, and I say, well, put your money where your mouth is. Show me that you will do that by giving your money away now. So if I start giving my money away now, it keeps me humble. And it also, I agree with what you were saying, the compounded effect of what that charity can do, what that church can do with those funds is probably a better compounded interest than you think you can growing it and then giving it when you die. And you won't get to see the joys of life change as in world change without doing it now. So I'm a big fan of giving now. And I will say what I've found to be true with client experiences, living hundreds of lives, watching families that retired. I think the families that do it best are the families that do the family experiences now. They say, instead of me giving you a lot of money with a cold hand, I'm going to start giving you money with a warm hand. And what I would do is I would pay for those family trips. You want to take all the kids to Colorado? Do it. You want to take them all to Disney World? Pay for it. Because I'd rather see your money be spent down and cash it all out with memories than get to the end and I start writing people checks at the end at a conference table.
I love it. Yeah, no, I've been telling my dad for years, I literally want his last check to bounce when he dies. Like, spend every single dollar you have. Because by the time he moves on to the next phase, we don't need the dollars anyway. So let's
Well,
experience
that's
it all
what good
together.
kids say. You know, with
Right.
bad kids, there's not enough money that they
You're
can give
right.
up.
You're right. Absolutely. Absolutely. Well, yeah, very interesting. So this went down a couple of different paths. I wasn't expecting it to. But yeah, no, I think this has been a really neat conversation. I'm curious for folks though that are maybe they just have some doubts about getting into commercial real estate with a portion of theirs. Is there anything that you would care to share to that audience before we wrap up and move over to the final five?
Yeah, I would think that, every asset, every investment has pros and cons. If someone ever tells you, here's all the pros, but they forget or leave out the cons, I would be concerned. I want someone to be enthusiastic about the cons and the disadvantages as they are the advantages. And so real estate is not perfect. It's an illiquid asset. When we want to sell it, we can't sell it. When we, want to get rid, when we don't want to sell it, typically that's the easiest time to get rid of it. And so
Exactly.
it's not a perfect asset, but here's where it is very valuable is it is a real asset. That's why we call it real estate. And so we're able to try to keep pace with inflation, but ideally beat inflation with our operating expenses because we can pass on those operating expenses to the end consumer. And that's why inflation is so terrible for the poor and the middle class, because it's not the rich that really are silently taxed by it.
Yeah, absolutely. Yeah, great, great, great. Great advice and suggestions to kind of finish this thing off. Thank you so much. So, well, let's move on to the final five. I have 5 questions I do like to ask everybody, and we're not going to let you off the hook on this one. So,
All
if
right, I'll
you
try.
are if you're thinking about our audience, which is generally newer passive investors, what would you say is one of the single most important educational resources that they could go to either start or continue their education journey?
Yeah, I think the best financial book, and this is saying a lot. It's one of the best financial books ever written, is Unconventional Success by David Swensen. David Swensen was the fund manager for the Yale Endowment before he died, and he has some of the best results we've seen. And he was a public fund manager. I mean, if he was in the private sector, he had probably made hundreds of millions of dollars, but he was able to, I believe, beat the S&P for a long extended period with less risk than the S&P, which is very hard to do. And again, his thoughts on alternative asset classes, I really appreciate. So it's a really great book.
And it's interesting that there's not a lot of folks that also bring alternative investments into a role like yours. It seems like folks are generally going to be in equities or looking at the stock market. So you're a unique professional that actually does both. I'm curious.
And there's a reason for that, is because I'm what's considered an independent fiduciary. So a fiduciary, unlike a banker, broker, insurance agent, even your doctor, does not have to make recommendations for your best interest. They have to make suitable recommendations. And I think being independent, the problem with the financial industry is I could be a fiduciary Ford salesman, but if you think you're going to get told about a Toyota Tundra, well, you're going to wait a long time before they recommend that. And so the same thing happens in the financial industry. If you work for, you name the financial institution, most of those are franchise situations where you're only going to get the brand of vehicle they offer you.
Yep, absolutely. And thank you for pointing that out as well, because you are unique in that type of offering. And it's more often than not, when people are talking to their financial advisors, they steer them away from alternatives because they're not going to earn any commissions on those. Generally, it's my experience. So
You're exactly right.
Thank you for doing what you're doing, because you can actually present a holistic approach to investing, much like you do with your own dollars. So,
well,
fantastic.
and here's what I would add. This is where I'm on a path of educating families is when we take advice from people, we're trading places with them. And you'd be shocked how many times I'm sitting with a bar with my colleagues just cutting up, and I ask them where they're investing, and they're not investing like their own clients. And these are friends of mine. These are people that I enjoy their company and we have a great time, but they don't recommend what they're investing in. Sometimes they're recommending stocks and annuities and bank CDs, but their money's in real estate. And I've always found that you need to work with someone that eats their own cooking.
I agree. And being a sales professional for 25 years, once you get to a point where you do not believe in what you're selling, you need to leave that job, is my belief. And same should be true for financial advisors as well. So thank you for that. We're in alignment for sure. Now, kind of shifting a little bit, maybe less on what you suggest for the newer, but what are you personally reading and listening to now? What type of books are on your nightstand, or podcast are you listening to and from work or at the gym?
Yeah, I really prioritize reading. So I try to read a book a week. I've done that since I was 14, and my friends used to poke fun at me when I read The Millionaire Mind. And then when they walked into my 2-story library, they said, okay, we should have read some of these books. So I'm always the biggest proponent of reading books. What I'm reading right now is, last night I was reading autobiography, but I'm also listening to a podcast by the name of Founders. It's a really good podcast if you ever own your own business or plan to, because he takes a 6-hour autobiography and he boils it down to an hour, and it's a good podcast. And so what it's inspired me to do is read some more biographies. I was reading some, but I wanted to read more. And so I'm glad that it actually encouraged me to do so.
I love it. Yeah, no, I literally this morning was listening to Founders NVIDIA episode that came out last week. So if you look at people that have accumulated wealth, significant wealth, or are in the process of doing so, you'll find that they're spending a lot of time researching those that have done that in the past. So very good. Great advice. Due diligence questions take up a lot of my time, and certainly yours as well, I would imagine. So what are, maybe one or two due diligence questions that passive investors should be asking that maybe they're not asking today?
Yeah, I think you should be asking about when deals did not go well. and hopefully they've had a deal not go well, so they've learned from that. I mean, we learn a lot from our mistakes and less from our achievements. So I'd ask them about a deal that didn't go well. I'd ask them about when they had to pay out a capital call. I'd ask them about when they had to stop distributions. What did they learn from that, and how did they try to improve their business plan to avoid doing that in the future?
Love it. Success is a terrible teacher, as they say, right? Yeah, very good. All right. And final couple questions here that are kind of fun, kind of personal stuff to get to know you a little bit more. But is there a recent bucket list item you've checked off your list or one you're hoping to in the near future?
Yeah, that's such a good question. I'm spoiled. I have done a lot of my bucket list items because I've witnessed many people put off their bucket list items and then they pass away or their spouse passes away and they weren't able to do it. I think the best money, if I'm giving out bucket list item ideas to other people, if you're a car person, I see a lot of people waste a lot of money on cars. And I like fast cars. I'm an adrenaline junkie myself. The best money I've ever spent was in Las Vegas. I'm not a gambler, so I spent, I think it was like $1,200 for the VIP treatment. And I went to one of those race experiences where I got to pick 5 cars and go 5 laps. And so I did like a Ferrari, an Audi R8, and I drove them like I stole them. Like I would never drive a Lamborghini like I drove that Lamborghini. And so that was the best $1,200 I've spent in a long time.
I love it. I love it. And anything you're excited to be doing in the near future? Maybe you and your family or you and others?
Yeah. So one of my favorite places that I've went to, like people say, oh, you've been all these places, 40 different countries. Where do you think was most beautiful? I think one of the most beautiful mountain ranges is Banff. And so we're going to go back this year to Banff. And I'm really excited about it because I wasn't married at that time. And so now to bring back my wife is going to be a different experience and a special one.
Yeah, fantastic. Thank you for sharing that as well. It's my parents have been through there. They said it's absolutely beautiful. I'm going to Canada in the fall myself, but not Banff. But beautiful.
You got to go back. I mean, I'm actually going to do the train trip this time, where you go.
Oh, you are.
Coasts.
Yeah, very nice. Yeah, my dad did that a few years ago, so it was amazing. All right. Well, let's see. Final question: if you had $100,000 that you had to place today, but you couldn't put it into one of your own deals, where would you put it?
Yeah, this is inspirational, I hope, and also gets us to think a little bit more. I would like to, if I had just $100,000 to, just put in investments. I'm actually right now working on something where I am going to put the next $100,000, and that's affordable housing. I am very excited about the future of affordable housing. I'd like to see more innovation there. I think a lot of the building codes per county across the country they need to be deregulated. So I think we should all ask our politicians locally to start deregulating some of the building code. And it doesn't mean hardening it from, disasters like we're seeing abroad. But, sadly, it's easy to build a house out of sheetrock, which is terrible for humidity and moisture. And we're making it out of sticks, which is really easy to burn up. And it's easy to blow away in a hurricane. And so it'd be nice to see more 3D printing of houses. I'd like to see more modular builds and different uses of concrete. So that's where, if I had $100,000, I'd bet it on some affordable housing innovation.
I love it. And actually, I just had an amazing entrepreneur on the show. I think we launched last week on his episode, Darren Christensen, doing modular housing. That is in Austin, Texas, and they have like a 200-mile radius where they're doing amazing things. So check it out.
That's cool.
Yeah, very good. Well, Andrew, this has been a really great conversation. It's refreshing to meet somebody in your role that is teaching people about alternative investing, commercial real estate. It's a very unique way to present these things. So thank you so much for all you shared here and all that you're doing in the community. Awesome.
It's my pleasure.
Awesome. And to the audience, as always, I encourage you to continue your education journey in passive investment. More importantly than that, though, I encourage you to make the decision to place your first passive investment. I'm convinced that once you do, you will just wish that you had started that much sooner. So thank you again for joining us again today, and be sure to join us again next Thursday for another great episode. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.